Starting something correctly avoids so many mistakes, redos, do-overs, however you're going to categorize it.
Welcome to Beacon for Business, the podcast that illuminates the path to clear, structured financial systems for established CEOs, entrepreneurs, and startups. I'm Brett Spencer, owner of Spencer Business Advisory. I help companies strengthen their financial health and streamline operations. Today, I'm speaking with Joe Huss, CFO for MHS Legacy Group, a nationally recognized specialty contractor. Joe has a wealth of experience. He's a native of St. Louis, Missouri, and a graduate of the University of Missouri, St. Louis. He started his career in public accounting with Ernst & Ernst, which is now Ernst & Young. Joe has held senior financial leadership roles for over 30 years with companies in a variety of industries, largely centered around general contractor and specialty subcontractor space. The vast majority of his experience has been with small to mid-sized privately held companies. Welcome to the podcast, Joe. Welcome to Beacon for Business.
Fred, thank you very much. It's a pleasure to be with you today.
Joe, could you talk a little bit about some of your experiences with small business?
I think we were talking about, Brett, perhaps some of my experiences and some of what I've seen with privately held businesses in various stages of evolution and development.
So Joe's had great experience with smaller companies and has been with fast-growing companies, with startups, and done several things with companies to help them succeed. So maybe you could talk a little bit about how you approach a new business, or a business that maybe has been in operation for a few years, but is maybe struggling with some things.
I think there are a number of ways to kind of approach the response to that question, Brett, and I believe that it exists upon a different continuous spectrum depending upon where a particular venture is in its stage of evolution. So if we start from a premise of a brand new business, someone who has an entrepreneur with an idea and is looking for a way to scale that idea and bring that idea to market, I believe there's a certain set of rules we can talk about with those. And then further, as we continue the conversation, there's probably a different set of metrics that we might want to apply to a company that's in a different stage of its evolution. Let's go to the very start and find someone who has an idea, and they believe that they can scale this idea, and they've had some success in the way they've approached the marketplace to this point. I think what's important to recognize is that those folks have a skill, and they've been able to take and bring an idea to a certain level of a commercial scale and have recognized the potential money-making and fulfilling opportunity in doing so. One of the things that I think folks like us, with our financial background, one that is based on structure, process, procedure, one of the things that we could sit down with them early on and visit about, and perhaps one of the most important lessons they could take away, is knowing what you don't know. They have a skill that we don't have. We have skills that they don't have. I think the ability to recognize that there is a synergy that can exist between those two skill sets would create a better platform. And as we both found out in our careers, starting something correctly avoids so many mistakes, redos, do-overs, however you're going to categorize it. And a little forethought at the beginning of it all goes a long way. And we know that more because you and I have done it. And I think one of the things you could start with is, what is the best structure for your company? No doubt, everyone starts off, they're an entrepreneur, they're a sole practitioner. And from there, I'm sure there are a variety of questions you might have as to what would be some of the ideal situations to kind of discuss and present to them.
So usually, you have multiple options for a company, and one would be sole proprietor. The next one up would be probably a partnership or a limited liability partnership. And then an LLC, limited liability company. and then a corporation. And within corporations, you've got the choice of a C corporation or an S corporation. So let's talk a little bit about the pros and cons of each. What are the pros of a sole proprietorship?
I think the pros of sole proprietorship are embedded in the title itself. It's you, and it's all the things that you want to do, and you are the only person who is in control. I would tend to say that everyone starts out organically as a sole proprietorship. However, I think that's probably on a going forward basis as you scale, that's probably the least desirable because you've afforded yourself no protection from potential liability of the enterprise in which you're engaged. And it also does not create the most efficient tax vehicle for capitalizing on benefits that might otherwise accrue to an entrepreneur. So I would venture to say that everyone starts out that way. But once you start getting a little momentum, it's probably time to look at a different structure. To your point, Brett, I would suggest, and what I've seen deployed most efficiently, is an LLC or a limited liability company structure. Those are entities that are taxed, if you will, as a partnership, but provide all of the same legal protections that a corporation does. In other words, it creates a vehicle in which assets, liabilities, expenses, and revenues are housed. And it shields that entrepreneur from a personal liability standpoint that he or she might otherwise be subject to as part of a sole proprietorship enterprise. Limited liability companies, or LLCs, are all based on state laws. And so I'm sure Idaho has its various laws regarding the formation and reporting requirements, et cetera, just as we do here in Missouri. To me, you can go on a state Secretary of State website. You can create an LLC in very little time. So the actual creation of the LLC, really a mechanical exercise.
Pretty straightforward. An LLC is kind of the beginning. It's a good place for a new entrepreneur to start.
But where the magic happens is in the operating agreement. The whole concept of operating agreement is really, these are the rules by which this LLC operates. And it is important, especially if you are contemplating additional participants in your business, such as additional partners, equity shareholders, as the case might be. And I know that there's AI and various uh, sites you can go on the internet and plug in a couple of dates and names, et cetera, and boom, you got an operating agreement. Your very first step should be to find a lawyer that you're comfortable with and put that operating agreement together, because it's going to account for all the things that an entrepreneur is not going to think of at the outset of a business.
One thing I've seen in companies is the owner of the company, the person who started, the entrepreneur, sees the company as his, and it is his. However, with some of the confusion comes when they don't necessarily understand that it is a separate legal entity. It has a separate tax ID number, and it was set up as an LLC, as a corporation for reasons, and one of the reasons is to segregate your personal assets from your company assets. And so, one of the things that I've seen some company owners do, and that is almost treat their company as an ATM. They take cash out for personal reasons. There's legal ways to do that, and that's usually through distributions. But if you commingle your personal, your corporation with your personal cash or assets, then that gives the company, that gives any entity that would have a challenge for your company, the ability to pierce what they call pierce that corporate veil, or pierce that entity veil, and your personal assets become fair game.
I'll give you, Brett, my personal experience is that sometimes you'll find two folks that are starting up a partnership and then they want to progress. and they want to formalize their arrangement in the form of an LLC. They get together and they're best of friends as they're starting out. And they each recognize the strengths and weaknesses of the others. And they put together the operating agreement and they don't put in a provision as to how to break the tie. Then all of a sudden, everything's great until it isn't. And that's when things can tend to really get confusing. So addressing those, as the saying goes, you begin with the end in mind.
Exactly.
And those are the kinds of questions that need to be contemplated. Excuse me. Those are the kinds of questions that needs to be contemplated. And those are the kinds of areas where CFOs like you and I, Brett, get the "you're just negative and you're in charge of revenue prevention" label that true to us at times.
So let's talk a little bit about the difference about an S corporation and how it's similar to a LLC and how it differs from an LLC.
The biggest similarity is and there are elections involved, but is the tax treatment of the two vehicles. Both are known as pass-through entities, so that either an S corporation or an LLC, the entity does not pay the taxes due on the income of the business. Instead, the income from the business is passed through to the individual members in an LLC or shareholders in a corporation that has elected subchapter S status. So while you get the protection from a liability standpoint, the income tax implications pass through to the individuals and are paid for on an individual level. Differences also between LLCs and S corporations really have to do with structure in terms of the number of participants you could ultimately bring into one of those vehicles. It's somewhat unlimited, and we don't use the term stockholder in an LLC. That equity participation is known as a member, while there are actual physical shares of stock issued in a corporation. So S corporations do have a limit on the number of shareholders, whereas those same limitations don't necessarily apply in an LLC environment.
How about owner's compensation? There's some changes. There's some differences between LLC and an S corporation for owner's compensation.
There are, and especially from an S corporation standpoint, you run into what's known as the guaranteed payment, where certain things need to be included in the compensation of the individual S corporation shareholders. You have a little bit more flexibility in that regard with being a membership interest owner in an LLC. Um, for example, there are life insurance or health insurance premiums and things of that sort that might be otherwise considered as an expense to the business. In an S corporation, a lot of that gets picked up as personal income on the tax returns under the sort of guaranteed payments umbrella that exists.
An S corporation, if you are employee of your own company, you're going to get a W-2 and at the end of the year. Whereas with an LLC, that's not necessarily the case, is it?
Not necessarily. However, both LLCs and S corporation can have you, Brett, as a shareholder, for example, or as a member of either an S corporation or an LLC, respectively. You could be a W-2 employee and you could still have wages. However, the company's income and your proportionate share of that income will be reported to you on a separate tax form known as its Schedule K-1. That's part of the income tax return that's filed by the entity. So you'll have another layer of taxation. Typically what happens is that, let's say that, Brett, let's say you are 100% member of your LLC and your LLC made $1,000. You would get a Schedule K-1 and you'd pick up $1,000 in your personal tax return. Let's say your tax rate is 25%. The company should send a distribution to you for $250. In other words, you pick up the income that the company also, and this is going to be all written into the operating agreement, they pay you the taxes due on the earnings of the business. So a long way of answering your question, it could be both. You could be a W-2 employee, but you're still going to pick up the share of the income that the entity earns through the course of a year.
Yes. And just to close that circle, a distribution is not an expense of the corporation. It is on the balance sheet, and we'll discuss balance sheets later. And so it does not decrease your income. It just is a deduction from your equity and from your cash balance.
That's correct. A distribution per se from a company that's specific to income taxes is not considered as taxable income to the recipient.
Very good. So let's circle back around and what would be the administrative burden between an LLC and a S corporation?
S corporations or corporations in general are subject to a little bit more periodic reporting requirements. Corporations and those that have chosen election and tax treatment under Subchapter S are required to file annual reports. They're required to keep board of directors minutes. They're required to make sure that an annual report discloses who the officers are, etc. Again, as I mentioned earlier, limited liability company rules will vary state to state, but generally those rules are a little bit more relaxed, and you don't have the same periodic reporting requirements. You don't have the same board of directors minute requirements, board of director meeting requirements that you might otherwise have under an S corporation.
And from my experience, and I'm sure you've seen the same thing, you come into a small company that's an S corporation, and there's some things you have to catch up on. A lot of them have not dotted every I and crossed every T, and have an annual meeting that's documented by minutes.
Generally on a cocktail napkin has been my experience.
Yeah. So one of the differences between an S corporation and an LLC is you have a larger administrative burden, but it's not overwhelming. It can be overcome.
I think also, Brett, to your point, the idea of establishing an LLC, for example, at the outset. And I think more we're talking about the insulation of personal liability from corporate, if you will, liability in that scenario. Should one progress and one finds that a structure of a corporation under the auspices of Subchapter S, that might make more sense depending upon their circumstances, you can always step toward that. But I would advocate that the initial step, the easiest step, ease of administration, less reporting burden, etc. And from a practical experience standpoint, I believe an LLC is probably the best way to start.
You can always change, right? Okay. And just a short note, S corporations came into popularity, 25 years ago or so. They changed some of the rules. The other type of corporation is a C corporation, and the C corporation you may have heard in the press that it's double taxation, because the C corporation is a separate legal entity, and you earn that money, and any money that is distributed to the owner is taxed, as well as the profits of the company. And this S corporation kind of takes care of that.
It eliminates that second layer of taxation initially. And I think, and again, trying to keep a broad spectrum involved, the estate planning and wealth transfer aspects of an LLC or an S corporation all corporations are C corporations upon their formation. You make an election to be treated as an S corporation for federal and state income tax purposes. If the company makes money, the company, I beg your pardon, a C corporation, will write a check to U.S. Treasury. If that company accumulates a lot of money and then attempts to dividend that or otherwise distribute that to shareholders and does not have the protection of Subchapter S, that will be taxed as ordinary income again as part of a dividend. To your point, that double taxation.
So let's circle back around, and you've got your idea, and you've got an attorney hired, and the attorney is taking care of the details that we just discussed and working with you on that. But then you need to set up your company. You need to set up a structure. You've got, say, maybe you've got 5 people to start with. You've got a pretty good framework that you've used in the past to determine what that should look like.
Yeah, and I think it would depend, excuse me, on the mix of folks that are in that, say, 5 employees or that initial core group of folks that are in there. I said this at the outset. I think one of the things that's most important for entrepreneurs is to acknowledge what they don't know. And their strength probably doesn't lie in bookkeeping or accounting. Finding that person within the organization or perhaps outside of the organization, finding someone who is going to keep the books, finding someone who's going to be able to say, we're up, we're down, we're rich, we're poor. The myriad solutions available from QuickBooks to automated payroll services to being able to kind of set it and forget it with some of those functions. Those are things that an entrepreneur should consider. And then he should also maybe, or he or she should perhaps consider going back to their attorney, always a good source of that kind of information. So, but when you're setting it up, Brett, really to your point, I think, you've determined that you've got a handful of folks, and those handful of folks are there because the entrepreneur, who is most likely going to be the CEO or the person who winds the stem of the enterprise, he's identified that they bring value to his enterprise going forward. Okay. So finding out what it is that those folks do well, and then taking a look at some of the functions that go into a company. Who sells? Who bills? Who builds or manufactures? Who collects? Who collects all the records? Determining the skill set of the individual folks that you're starting out with, I think is a critical key, because in any structure, there are always going to be the must-haves that are going to have to get done. And again, an entrepreneur doesn't get to where they're at by thinking about those kinds of details so much. They can only think, I mean, at least my experience has been, they see one thing, and that's forward. That rear view mirror is an accessory, okay? They're looking forward.
The entrepreneur, in my experience, is a subject matter expert usually. They've either invented a product or obtained the ability to sell a product, or they have a service to provide. And so they aren't accountants necessarily. Sometimes they are, but usually they're not. And so just as you and I, as accountants that have spent a few decades doing this, aren't necessarily subject matter experts in what the entrepreneur knows, they aren't subject matter experts in accounting either. So that's kind of how I decided to do this. Was I was the first accountant. A lot of times I was the first accountant, period, or the first controller or for CFO for several businesses. And so I've seen it, and you've seen it over and over again, where they've built a good company. But there's something going wrong. One of the questions that I get a lot is, I've got profit, but I don't have cash, and I can't get any sleep at night because I'm worried about how I'm going to make payroll, or I'm worried about I'm going to pay for this shipment. Can you talk a little bit about that, Joe?
I think part of that fear is natural, and it speaks to a lack of understanding. So not a lack of knowledge, but a lack of understanding as to the mechanics of how a business should work. We, Brett, as CFOs, we have a certain lens with which we see things. And then you compound that for the number of years that you and I have been doing it, and it kind of becomes second nature to the way you and I look at it.
I described it once to an entrepreneur as muscle memory, but maybe it's the muscle memory up here, but
It's the way we look at things, and I think what I found out, what has been successful for me is, as accountants, Brett, you and I can talk accounting. We can speak that accounting language. Okay. What we need to do to be successful is to be able to speak and know who our audience is. So in other words, if the audience is the CEO and he's a great entrepreneur and he's got drive, or she's got an idea that's getting ready to scale into the market, we are the ones who protect the downside. We are the ones who protect the flanks. We point out the trapdoors and the tripwires. We need to be able to do that, though, not so much with spreadsheets, not so much with PowerPoint presentations, but being able to sit down and say, this is how it works. And I think if I could give advice to any young accountant out there, it would be, you have to learn how to speak the language of your audience, and your audience isn't always accountants. So, so many times I've tried to put it, Brett, well, how do you run your household? You make so much a month, right? What's the first thing you got to pay for? I got to pay for the mortgage. You got a car payment? I got to pay for the car payment. How much is your electric bill? What's your water run? Are your kids eating out of house at home? In other words, you run it from the back to the front. This is what I spend once a month. Come hell or high water, this is what I spent. I got to figure out how to make $1 more than that.
Yeah. Either that or find a market for kids, but that's probably not going to work.
Fred, as I recall, you and I have the market cornered.
Yeah, we've done that quite well.
No, but the point is, you explain it to them in those sources. If you bring it from the bottom up and saying, the minute we put the key in the door, the minute we throw on the light switch, what are we spending? And so you have to know what your foundation is. You're not going to build a building from the top down. You're going to build it from the bottom up. And so explaining to them, this is what it costs to do business. I'm not talking about making money. This is what it costs to do business. But we have to get to a point where we take in at least this much. Now, to your point, are they billing their customers timely? Do you have an invoice that says you got to pay me in 10 days? If I'm going to go do the work and then I'll get around to collecting, I've seen some of the most successful sales and front end of the business oriented folks tell them to go ask somebody for money, and it's like you're speaking a foreign language to them.
Well, and that's a good point. I've always been a little concerned about asking for a salesperson to go use the relationship they've built with their customer to ask for the money. But that's a good place to start, is you mentioned it to them, especially if you got into the point where the guys like you and me say, we can't afford to sell these guys, this company anymore, or this customer anymore. So,
and I think that an approach I have found successful is that if you go to a salesperson who really is responsible for the customer relationship aspect with that particular customer, and you go to them and say, they owe us some money for what we've done for them, and I need your help. I want to come back to that phrase, by the way. I need your help in getting them to acknowledge what their obligation is and coming up with some idea as to when we're going to get paid. And they hate that idea because, to your point, they think it might ruin the relationship. Well, what I've always found successful is you built your whole career on being able to ask for the order. You're good at asking for and getting what it is that you want. Apply that same skill set. And we're not asking you to leverage your relationship, but we're asking you to use it to help our customer acknowledge that they have responsibility in the transaction as well. And I found that to be successful. Yeah, I use that phrase. One of the things that I try and do in my own particular situation and have for the last so many years, when I'm confronted with a situation where I could tell you black and white from the accountant's lens again, that boy, are they screwing this up. Okay, that's you and I have been in that situation, Brett, and we're looking at something and it's like, this is a mess. Now, it's fine to say it's a mess. If that's part of your act, don't open with it. When you go to the CEO and say, yeah, it is a mess. Okay. Everything you say after that is going to get tuned out. I learned this from a very good friend of mine, and it's been a very helpful technique. I start a lot of conversations in potentially difficult situations with, can you help me understand how we have gotten to the particular spot that we're in? Okay. I think it tends to disarm people because on some level they know things aren't exactly right. But starting with that phrase, help me understand, facilitates conversation and goes toward that building trust that becomes such a critical factor.
And your customers are really vital for your operation, obviously. And you need to have customers who, to some degree, act as business partners. They have their role and you have your role. Obviously, you're from two different entities. It's to nobody's benefit if you can't afford to do business with them. If you have to cut them off and say, I can't do business with you anymore. So to build that relationship is very important.
And I think you've touched on another important point, especially as an enterprise wants to begin to scale and take on new customers. Most of these relationships are going to be built right from scratch, and it's the entrepreneur, him or herself, who is the driving sales force. So it's going to be them that has that relationship with potential customers. As you get bigger and as you bring on more folks to service a bigger platform, the ability to vet a customer and their ability to pay becomes a bigger and bigger part. Brett, you and I have both businesses before where the answer literally becomes you got to fire that customer because they're not paying.
I try really hard to come to yes, but sometimes that's not possible.
No, it's an occupational hazard. I'll accept that.
Yes. So you've talked to me in the past. Let's go a little bit back to structure. Regularly review and adjust the structure and then implement the SMART framework. S is specific, M is measurable, A is achievable, R is relevant, and T is time bound.
I think specific is important. They're all important in their own way, but specific and measurable. Anything in life that doesn't get measured doesn't get rewarded and doesn't get corrected. Specific means the more you can tailor what it is you're trying to do. And I think the timely becomes a very big part of it as well. Coming up with information well after a situation or a transaction occurs. At that point, it becomes armchair quarterback, and you really are not addressing the situation as it tends to occur. So I think all of them are important in their own rights, but I think that there are some of them that carry a higher degree or higher weighting of importance.
And I think when you talk about roles and responsibilities within a company, whether it's any of the structures we've talked about, you have hopefully healthy stresses between the different parts of the organization. You've got accounting, you've got sales and marketing, you've got production, and depending on the type of company you are. And I think that the stresses a healthy stress is good because you hold each other accountable and you hold each other to what's best to drive the company forward.
That's an excellent categorization of healthy stress. It's important that the sales organization understands the value that the finance organization brings. It's important that the finance organization, and believe me when I say organization, it could be one person, but it's important that they know what the operations or manufacturing side brings. This is getting at the essence of the difference between managing and leading. And a leader is the one who is hopefully that CEO, that entrepreneur that started the enterprise. Leading is the ability to get the most out of the people that you have selected that best meet your particular goals, vision, and are going to be positive contributors to the culture that you are trying to establish. That culture of healthy stress is one of collaborative interaction, not finger pointing, not grabbing necks, but being able for everyone to be able, and this is, in this dream world sometimes that I exist in. Um, Sometimes people in certain emerging businesses, especially when things are starting to boom, they tune into the what's in it for me network, and they begin to lose sight of what the overall goal of the organization is. I've always believed all boats rise on a high tide. And so consequently, if you're participating in an active participant in a team environment, but we talked about culture, Brett, that's what separates the winners from the losers from an entrepreneur standpoint, because you have to be intentional about your culture. You have to find people. You can look at a resume, and a resume is going to indicate, or at least give an indication, I should say, of a potential set of technical skills that might be required to discharge the functions of a certain responsibility. Line them up. You can go to any source of resumes and you can tick the boxes on those kinds of skills. The ability to assess whether or not that person is a fit with the culture, that's the biggest challenge I think that entrepreneurs face as they continue to try and grow their enterprise. Because again, you get the wrong person in that spot and it can set back everything that you're trying to accomplish.
Exactly. I came to the conclusion a few years ago that I would look for the minimum standard of technical skills possible. But then after that, it's who's going to fit in the culture and who's going to promote the culture versus someone who would just, they just don't think that way. So, and the culture can take a great company and make it greater, or they can make a great company and create huge challenges.
And I think what ends up happening is that, there's almost a presumption on our part that entrepreneurs possess that skill set to be able to make that assessment. That's a work in progress, and I can assure you, just like you and I have, Brett, with present company accepted, of course, we've made we've made certain personnel decisions that we, in a quiet moment, scratch our heads and I wish I had a do-over on that one.
Yeah. Yes.
So they'll
Luckily,
make mistakes as they go along. It's human nature. But what got them to the point of being an entrepreneur is that they're not afraid to take a risk. They're not afraid to take a chance. And that's going to continue to pervade everything that they do as they go forward.
to talk about accountability, and I think everybody needs to hold themselves accountable and to help other people hold other people accountable. And so when I get someone from sales or someone from production that they come and want to spend some money on something, um, the best scenario is when they have costed it out. What's it going to cost? What's it going to take for manpower? And what is it that we're going to gain from it? A lot of times I don't see that. It's like, well, I saw this in on a website, or someone was telling me about, this would really help our business, or from a sales standpoint, we need to do more social media advertising type of thing. Um, I think what's really important, especially for young companies just getting started, or maybe companies that have been around for a while, but maybe they're going through a transition, maybe the market's changed on them, is they need to do that work to do some analysis of what it is we expect to gain and what it is it's going to cost us, both in cash and in manpower, which translates into cash as well. Anything you can add to that?
Yes, technical accountants like you and I, we love to throw around terms like return on investment. And that plays well when we're talking to financial types, bankers, etc. But the way you categorized it, Brett, which is tell me what I'm getting for what I'm paying, and then tell me it's going to pay for itself. I think ROI, you can apply the term return on investment to multiple endeavors that don't have anything to do with business. And it's okay, what am I getting out of this? And you can apply it to relationships. Is if you feel you're not getting something for the value that you are putting in, the question becomes, well, what am I getting out of this? I know what I'm putting in it, but what am I getting out of it? And I think if you put it in those terms, and then can it be refined from there? Yes. But if you put it in terms of if you're going to spend X, are we going to get Y? I also think, though, that especially with an entrepreneur, for example, this is a teaching moment to be able to help them get into a mindset that says, this is what is going to cost me. What is it going to benefit me? And helping them to start to think. And muscle memory was a great way to put it, Brett, is that, repetitive exercises, and you start applying that same thought process, that same mindset to different situations, it becomes reflexive, to your point, and you always start to begin to view things with that end in mind kind of mindset, or what am I getting out for what I'm getting into?
Yeah, it's the Stephen Covey habit of start with the end in mind.
It is an influential book, and I'm not certainly being compensated to say this, but that is a book that everybody, not only for business, a lot of life lessons in that book.
Anything else you can think of, Joe, that the message we need to get to young entrepreneurs or companies that are struggling?
I think in summary, the best advice that we could give any entrepreneur is to allow them to acknowledge the things that they do well. Okay. I think the biggest advice we can give them is honestly assess what it is that you don't do well. Be willing to accept help on the things that you don't do well. Ask for advice. If you can somehow find a mentor who has already made all of the mistakes that you are about to embark on, they might help you avoid some of that. Eh, Entrepreneurs, obviously, they've achieved a certain degree of success. And I think anyone who goes forward in their professional career, you have to have a certain amount of ego that goes along with that drive to help you achieve that level of success. But again, I guess, the philosophical me at this age is been through enough to say you absolutely have to recognize what it is that you don't know. And admission of that is not an admission of weakness or incompetence. It actually is an admission of strength that says, I'm looking to backfill the things I don't do well. And I think we could talk, as we have, Brett, about setting up a correct structure, setting up the right text, setting up the organization. But I think the biggest thing that an entrepreneur has to develop is a degree of introspection that allows them to be able to say, I want to keep going in that direction, but I got to get somebody over here to take care of me on the things that I'm not good at. Quite frankly, I don't want to do, but I know are necessary to running a business. So I, I think it's more on a human level than anything else is the advice I try to pass on to folks that are just starting out.
I totally agree. It's you've got there's a lot of resources out there on the internet or through an attorney or through a CPA that can help you with your, should I be a corporation or should I be an S corporation or should I be a partnership or an LLC? And those are fairly quick discussions, but the rest of it is the real heavy lifting. The rest of it is building that organization that has a culture that is effective, and you've found yourself with people who have the best interests in the organization.
That's the path to success, and it's not easy, but nothing worthwhile achieving ever really is easy. So being able to identify, being able to just recognize the things that you don't do well, I think that's a great strength in people. If they have enough confidence in themselves and in their abilities to acknowledge, I don't do this well. I need some help with this.
And I've worked for companies where the owner, entrepreneur, the founder of the company was brilliant, but it's like the difference between a leader and a manager. They're both important roles, and some people have both capabilities. But this person I'm thinking of was an incredible leader, and he stretched the infrastructure to the point where we worked very hard to try and keep up with him. But we went from a $25 million company to a $75 million company in fairly short order because of his vision. And if he would have, we often talked, if he would have sat down and thought about the infrastructure and the things, he might have been scared off and not done it. So.
And he was sprinting, and the rest of you had to kind of keep pace. But that's what got him to where he was or where she was. That's where the importance of asserting yourself. Again, I'm speaking from financial types and what they can do. You assert yourself into that situation, and you create the trust within your relationship with the guy who's winding the stem, the guy who's out there selling. You create that trust by being open and honest in your communication. Sometimes you're going to tell them things that they don't want to hear. It goes back to, well, how are you going to tell them that? And that's the skill that you've got to be able to develop.
Yeah. And we've discussed this in the past. I try to, if I have to go to an owner or a CEO with bad news, it's not always possible, but I try to have a couple of solutions that I can present at the same time as with the bad news.
Well, that and the fact that we go into those kinds of meetings, Brett, knowing that it's going to be our fault at the outset, and then we're trying to kind of minimize that as the conversation continues.
Well, I really appreciate your generosity to join me today, and I think that I couldn't have picked a better person to be my first guest on this podcast. So,
well, you're very kind to say that, Brett, and I'm grateful for the opportunity to be with you. We've got almost 25 years history between the two of us in a working environment that could become the subject for a future podcast. But we've come out on the other side, and I wish you nothing but the best and success in all your endeavors on this.
Thank you. I really appreciate it, and the best for you and your family.
Thank you so much.
Thank you, Joe.
Appreciate it.